Welcome to the Sage Advice Podcast, transforming the way people think and work so their organizations can thrive. Well, hi, everyone, and welcome to our podcast. I'm Ed Kless, and with me today is Dr. Reginald Tomas Lee. Dr. is the Executive Director and innovator in the areas of cost accounting, modeling, and cash management, cash profitability, capacity management, and supply chain. He is the author of Strategic Cost Transformation and one of my favorite all-time titles for a book, Lies, Damn Lies, and Cost Accounting. He also has the forthcoming book, Project Profitability, in the works right now. He advises executives and their teams, helping them improve cash, capacity use, and management, and accounting profit. Dr. Reginald is the professor in operations at Xavier University. Welcome to the Sage Advice Podcast, Dr. Reginald Lee.
Thank you, Ed. Happy to be here.
And full disclosure, Dr. Lee is also a fellow of the VeraSage Institute, that where both myself and Ron Baker often do some speaking. So we're glad to have him here. But
Thank you.
Dr. Reginald Lee, why do you do what you do?
That's a really good question because it doesn't seem to have followed a direct path. You know, for instance, my PhD is in engineering, yet I teach business and I talk about cash. So that's not really a direct relationship there, right? But I think the reason I do what I do is because I just have this innate passion for business. You know, it's just a deep passion for business. And in graduate school, I realized that there were some limitations in the math of accounting. Basically, what I was trying to do was try to figure out how do I use accounting to explain what we were trying to do from an engineering perspective. And when I looked into the math, I thought, what in the heck is going on here? And so really, I just went back and started thinking through how would an engineer do this. And when I came up with the modeling, I thought, this is kind of cool stuff. And so I just kind of created a whole passion around it. And I've just been running with it ever since. So, you know, ultimately it's to help businesses understand how they make bad decisions using accounting data and how to make better decisions using cash and operations-based data.
Well, and let's talk about that. So what's
Sure.
wrong with cost accounting, in your opinion? What's wrong with it? It's great. Everybody does cost accounting.
Well, it's let's break it down into cost and managerial accounting, right? So cost accounting, you have to do it for reporting purposes, right? And so what I'm doing is I'm looking at what happened in the past and trying to follow certain rules and guidelines to say, based on those rules and guidelines, here's my information, my cost information, revenue information, et cetera, right? I've got to do that for reporting purposes. That's kind of okay, right? But when we start getting into management decision-making, that's where it really becomes a problem. You know, for instance, one of the examples I often give is, you know, with this iPad pencil. If Apple says it costs them $20 to make this pencil, who are they giving that money to every time they make the next pencil? And when you start probing into it, people realize, well, it's not really a cash cost, right? Every time I make something, and I can assign a cost to it. But that doesn't mean cash is leaving the organization. You know, I was sitting with some professors one time, and we're debating this. And I said, for instance, we can calculate a cost associated with this meeting based on our time, but that doesn't mean there's any money that's tied to this meeting that the organization is spending, right? So when we start using management accounting and cost accounting to calculate these costs, we start thinking that they're tied up in money. And what ends up happening as a result is that we make bad decisions. For instance, if you look at the cost of that Apple Pencil, if that's not money, then there's no cash margin associated with selling one, right? Because if I sell these things for $120 and my cost is $20, I'm looking at the revenue that I bring in, but I'm comparing it to a non-cash value. So what people will do is they'll say, well, I can't sell this for $19 because I'll lose money. And so when I don't really understand cash and non-cash cost, I, as a business person, may make decisions based on trying to improve my profitability that can have a negative effect on my rate of spending money, or a negative effect on my rate of receiving money. An example of that is when we start thinking about, in some cases, buying software, right? Because I've talked a lot about this. And part of what I try to do with software companies is help them understand where your value proposition is truly coming from. So if I come to you and say, hey, Ed, I've got this great software, and it's going to make my finance and accounting organization much more effective. So I've got 10 people, each making $100,000. That's $1 million. And if I can make them 10% more effective, I can save you $100,000. So buy my software. But the problem is, once I implement the software, the people are still working there. and I'm still paying out that $1 million. And so if we don't understand the difference between cash cost and non-cash cost, then we make those types of decisions thinking, oh my God, we're going to save $100,000 buying the software. And we buy the software, we implement it, and we don't see the savings. And so part of what I try to do is help people understand the difference between the two of them so that they can make better decisions.
So let's talk a little bit more about that. If you could give
Sure.
a quick definition, what is the difference between a cash cost versus a non-cash cost?
Absolutely. So what I did initially in coming up with this model is use some engineering approaches. And the first engineering approach is let's put a box around the thing we want to analyze. So in this case, we want to analyze a company and its cash levels, right? And so the only way the cash level of a company can increase or decrease is if money comes into the organization through sales, for example, or money leaves the organization through things that I pay for. Most of what I pay for is capacity. So the people I've got to pay, the space that they work in, the materials that they use, both to do their jobs and to make things that we end up selling, the equipment that they use it on, et cetera. So those are things that I have to pay for. Money leaves the organization when I buy these things, right? So I can see a distinct impact when I buy these things and money leaves the organization, okay? A non-cash cost, really the idea behind a non-cash cost is I don't have a direct relationship between the things that I buy and the output. And I'll give you an example that I often use. If you think about a telephone, right? And we have local telephone service, landline service. I pay $25 to have unlimited access to local calls, right? But if for a long distance call, let's say it's 10 cents a minute. So we know that a 10-minute long distance call will cost us $1. But then I ask the question, what's a 10-minute local call cost? And there's always a pause. And that pause is because there's not a direct relationship between what you bought, which is access for the $25, and what you did with it, make phone calls. And so to get the cost of that call, I have to create a relationship between these two things. And the two things mathematically are independent. If I buy that access for $25, and whether I make 0 calls, 10 calls, or an infinite number of calls, the cash cost to me is $25. That's very clear. But now when I've got to try to figure out how much that 10-minute local call costs, now I've got to figure out, okay, so do I come up do I divide the $25 by the total number of calls that I made, the amount of time I was on the phone? How do I create the relationship between that $25 and that phone call? And mathematically, you can't do it. And so that's where the problem comes. And so when I calculate these costs of a phone call, of a product, this Apple Pencil, of an activity with activity-based costing, of a service, when I calculate these costs, in most cases, they only represent the value of the capacity that I consume and not the dollar value that left the organization as a result of creating this product, performing this activity, or offering this service.
So we're recording this podcast on the 19th of June, 2020 in hopefully the tail end, but we don't know, of the COVID crisis. And before we started recording, you said something really interesting to me that I'd like you to speak about for a few minutes. And that is, as we rebound, as people come out of this, what should they be concerned with and looking for with regard to how they manage costs, with regard to, hey, I'm coming out of this economically, but there's still a slowdown. How do I manage my costs internally?
Sure. So one of the things that I'm talking to folks about that's important is let's focus on making money. Let's focus on the cash elements of that. And if I focus on the cash elements, then I'm looking at things such as the rate at which I'm bringing on people, right? Because if I've got to start bringing people back, then there's going to be a cash hit every payroll cycle. So when do I bring people in? Well, that depends on what jobs that they have. It depends on how efficiently and effectively I use the people. The same thing in terms of any other types of expansion. The timing is going to affect the rate of cash that I've got to spend out of the organization. And so what I'm trying to do is get companies to not think about things such as what are the margins that I'm making on the products that I'm offering, right? And trying to figure out how do I get the greatest margins, or what are the different products right now, since I don't have a lot of sales, what are the products I should be offering to generate the greatest margin? Instead of that, to go over and start thinking about cash and saying, what's the rate of money that's coming in? What's affecting that? What can I do to affect that? And then tie that to the rate of money that's going out as a result of the payments and purchases of capacity, for instance. So when you think about it from an operations perspective, when I buy inventory, I may get a great deal for inventory right now, But if I don't need it and if I don't have the cash, I may not want to go with the lowest cost per pound, for instance. I may want to go with a higher cost per pound and spend less money. You see what I'm saying? So that may have a negative effect on our margins. But from a cash perspective, it helps us manage the cash because I'm not spending $50,000 to meet demand. I'm only spending $20,000 to meet the current demand. Does that make sense? And so my objective is to help people understand the operations and cash implications of the decisions that they're making. What capacity am I buying? When do I have to pay for it? Is it absolutely necessary now? When we start thinking about growing the business, who are the key elements I need to bring in so that as we grow, for instance, do I bring in sales, for instance, before customer service because they're going to be a leading indicator for arguably for the need for customer service, right? And so it helps them think through, okay, so if we bring in sales, what's the cash impact of that? Beginning at the end of the month, payroll is going to increase by this amount. Are we going to have the sales to offset that, right? We start thinking about areas of our plant that may have been mothballed, thinking through, okay, well, do we want to open up the whole thing right now? Or do we want to open up certain areas, keep that cash spend at a minimum until we can start growing and then start expanding? Those are the kind of decisions that affect how much money you have and how much money you'll make, much more so than thinking about things such as the margins you make, given the fact you've got all the folks out there in the factory pumping out products.
And Reginald, we have an exit question we ask all of our guests, and that is, who is a hero of yours and why are they a hero?
Wow. It's really interesting that you asked that question. And I thought about that answer an awful lot. And I think today, being a Black guy, it's really interesting being Juneteenth because my mom is probably my greatest hero. And part of that is because my mom had, she lived through the riots of the 60s and, civil rights and such. And my mom living through that had racial issues. And she looked at those racial issues and said, I don't like that I have this problem. And she fixed it. And she was very good at that throughout life. When things aren't right, our job was to understand whether they're right or not and to change them. And this isn't, my dad was wonderful and they were just an awesome pair. And I learned so much from him. But my mom, when it comes to life and living life and, when we say things and when we do things and when we see problems like, as we've been talking about with accounting, our job is to try to go out there and fix it, try to change it, whether it's for ourselves or for the good of others. And so in that context, I definitely have to say it's my mom.
All right. And lastly, Dr. Lee, how can somebody get a hold of you?
Sure. Probably the two best ways are email. So it's Reginald, Reginald.Lee @bdrco.org. That's B as in Baker, D as in David, RCO.org. And phone, probably the best is 513-800-9476.
All right. Dr. Reginald Tomas Lee, thanks so much for being a guest on the Sage Advice Podcast.
Ed, thanks for having me. I really appreciate it.
For more Sage Advice, visit and subscribe at sageadvicepodcast.com.